Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Good morning, Jim. Good to be with you and the listeners.
What's happening on the bond market?
Well, you've had governments all around the world buying bonds. The reason why they were buying bonds is they could believe that by inflating asset prices, that would then put up commodity prices, and that would then put up all producer prices and everything else, and it would all help the economy. Now, the theory from the start has been naive anyways, because it was more wishful thinking and intuition rather than actual research. So anyways, they've been buying the bonds, and it's been effectively a one-way street. And what we've been discussing over the last couple of months is that the real leverage in a bond price change is that if you have a low coupon, like back in the late 70s when interest rates in Canada went up to 19%, that was a very high coupon. And then now that they're down around 1 or 2%, depending what maturity you're at a low coupon. And the way the arithmetic works is that a low coupon and a long maturity, wow, you get price change like you wouldn't believe. So anyways, this is what's happening now. It set back a bit yesterday, but it got hit pretty hard today. No news that I see related to it. Perhaps weakness again in crude oil today would be helping, because there was maybe about, I don't know, a number a few years ago, 18% of new bond issues done back in 2014 were petroleum related. But anyways, nonetheless, it's one of those days where everything is moving adversely. You're looking at high-grade bonds with long-dated treasuries. European yields are up as well. You're also looking at, in U.S. municipal bonds, which are pretty closely tied to the treasuries, down in price, up in yield. And you've got high-grade corporate bonds, same thing. And then you got emerging market bonds, same thing. So it's a universal move all around the world. And we had, a couple of months ago, did work where we pointed out that using long treasuries, the price advance had generated upside exhaustions, a rare one, and other technical stuff, though we suggested that could be the end of the big bond market. The other issue has been that where the European Central Bank can, so to speak, buy all the corporates that exist in Europe and own the whole thing, in which case you think they might be able to control it. But when you move over to the Treasury market in the U.S., the whole of the world is in that market, not just dedicated central bankers or dedicated governments. So you have loose cannon all over there. So our thesis was that once the market broke, there would be enough independent traders outside of central banks to actually to move the market. So you've had central bankers moving bond prices up to unrealistic prices. You've had trading desks around the world that would be positioning on short-term trading considerations not trading, so the liquidity went out of it, and mainly because it's just so absurdly priced. So you've got this huge ticking time bomb here of most distorted bond market in history. This has never happened before because you've never ever had central bankers driven totally by theories. I mean, there's no bankers at central banks anymore. They're all economists. So you've got the PhD standard. These guys have got degrees in currency manipulation and interest rate manipulation without any discipline. There's been no negative feedback for them. So it's been a positive feedback mechanism that has gone to the limit. So this is a major change in interest rates, and we welcome it, and it will be profound. Now, the other thing that is of interest is that we're going into the season where improper trading can be discovered, like people highly leveraged, and we'd expect that there'd be trading desks all around the world who, one way or another, are highly leveraged in this whole bond game because it had the guarantee of governments that, hey, you got to go with them. It's like at the top of bull markets, say back in 2000 or 2007, you had strains coming into the credit markets, and you then had the perma bulls who were then wanted to defend their position. So then the mantra became that no problem, because the Fed, with perfect timing, would cut the administered rate. So they said, stay long because of the Fed cut. But that's just a theory based on no evidence. Because if you look at interest rates, I mean, you just have to go back 300 years. Interest rates go up in a boom and down in a bust. So, and even if you just looked at 1929, you would have seen that interest rates peaked and using the Fed funds, the Federal Reserve discount rate peaked in August at the 6%, and then came down. And they came down to, well, if you look at Treasury bills, next to nothing, zero, in the 1930s. So here we are again. And 2007 was the same thing. Stay long because the Fed would cut interest rates, and then the market crashed and interest rates went down. Now, interest rates, Fed funds and administered rates and things like this are all now so low that any discussion about making them lower is meaningless. And but what you have is now you've got a new theory for staying long, and the new theory is that the Fed's going to buy bonds when they've been buying bonds for decades now. So that's an old story. But anyways, it was interesting to look around and find out what the main comfort was for those who really wanted to stay long the market. So anyways, today's quite exciting. They've hit bonds all around the world in price. That's come down, and stocks are weaker. Like looking at the S&P here now, opened down considerably right at the start, went sideways for about half an hour, dropped down to another level, 2160. The close was sort of 2182, and then dropped down to 2155, and then traded sideways at that for a while, and now it's at 2150. So there's been very little relief on the way down, and it's a pretty tough market.
Well, you keep saying that these people running the central banks are making the same mistakes. It sounds like instead of just taking economics, somebody should force them to take a history class or two.
Oh, you hit it exactly right, Jim. That was it. The problem is, you go back to the start of the Fed in 1913, and the people promoting it were, some lead bankers of the day, Warburg, people like that, were fearful of the financial markets. Now, they were employed in the financial markets, so why should they be fearful of them? If it's overdone, you get out, and if it gets underdone, you get in. So at any rate, they had this idea that they knew that when you have a financial setback, a serious one, it's followed by a recession. So then they figured we'll have the Federal Reserve, and it can prevent, by being a lender of last resort, it'll prevent financial setbacks. Therefore, you won't have any severe recessions. Now, that was 1913. The Fed opened its doors in January 1914, and I counted it, and I think there's been 19 recessions since. So it was an intuitive idea. It was a nice idea. It was a comforting idea. But it has never worked. Now, not just 19 recessions, but you had a huge boom in commodities right up to 1920, then an unbelievable crash in commodities. Then that set up the inflation of financial assets that blew out in 1929. Then you had the Great Depression. Then you had a long period of economic expansion. And you had commodities reach their very, very best, wages and commodities and CPI inflation in 1980. And then the Fed maintained its constant expansion of money supply and credit. And you went into a commodity crash, and then you ended up with inflation in financial assets, which has essentially been going. And here is the Fed's frustration. They keep thinking that Fed ease will push commodity prices up. This week you had new lows for corn and wheat. Weak prices for base metals. You've got weak prices for the grains index. And these have been, in the case of wheat and corn, new lows for the bear market that's been on since 2011. So the old recipe of Fed pushing and getting commodity inflation doesn't work. So then the other one is that the gold bulls are working on the same theory that the central bankers are, that central bank ease pushes up commodity prices, and particularly gold if you happen to be long gold. And that hasn't worked because you were in a bear market for gold and silver since 2011, when the speculation there became very evident of overdone. I mean, you had silver-gold ratio, which is what we use, on the RSI, the high, it got up to 92. And the only time in history that it ever got up to that one was in January 1980, which was the top of that market. So anyways, but then to talk about gold in more recent times, in November, we saw things getting in place for a potential bottom, described what was needed, and hoped that it would be all in by Christmas. It took until January. And we're now in a new bull market for gold. But it's going to be a different bull market. It doesn't require the price of gold to be going up in U.S. dollar terms. All it needs is the real price of gold to be going up, like mining costs to be falling relative to what miners are getting for the bullion. And we have that. There's a lid on wages. There's so much devastation in base metal mining that, during in 2011, the mining companies had trouble getting tires for their big moving equipment. So we're in a cyclical bull market for gold in real terms, and we're in a cyclical bull market for the stocks. And but we're in for a correction here. The gold and silver sector became really quite overbought a month ago, and it's going to correct. And also, now that you've got a distinctive break in the big stock market, gold shares will, where they might have corrected and declined based upon their own excesses accomplished in July, they're now going to be assisted on the way down with the weakness, general weakness in the stock market. And this, of course, then, Jim, brings us to what month of the year is this? September. And when can discoveries of over-leveraged bad trading typically be found? Late September and into October. So we had extremely high-priced markets going into the time of year when risk can be discovered. So this makes today's step and hit to the stock markets a very good warning on what the rest of the month can bring, and also it could run into October. So
we'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, security guards stand outside of most banks trying to keep people from robbing them, but perhaps the biggest robbers are in that bank. Wells Fargo fined $185 million for creating false accounts and credit card accounts, moving money around, and then charging you NSF fees because there wasn't any money in that false account.
yeah, I read about that one. There was an incentive to open up new accounts, so people were opening up new accounts, and the overall system didn't have a way of determining whether it was real or unreal until, I don't know, somebody took a look at it. But again, the banking systems are, you can't run a perfect bank with discipline from the very top to the very bottom. It just is difficult. You can hope for discipline, but actually, I can't remember who it was, Jim, but somebody some decades ago pointed out that the risk to the financial market from malfeasance within a bank is minimal. The risk really is when they all lend, straightforward business, too much money to one sector or too much money everywhere, as of recent. So, yeah, it's disheartening to see malfeasance discovered, but the risk is that's not where the risk is. It is elsewhere. The big risk here is that there was no discipline on the central banks, who had assumed godlike proportions and have been reckless beyond imagination. First of all, realize that the point of view I've had for decades now is that just the concept that a central bank, through currency manipulation and foreign exchange and interest rate manipulation, can manage an economy, that is an extremely speculative point of view. And just because it's been in the case of the Fed, for 100 years doesn't mean that it is legitimate or a sound point of view. It still is speculation. Just the idea that some agency can run things is a highly speculative idea. So bad enough to have that. And then now, in the last 20 years, where they have been absolutely dedicated to making sure nothing goes wrong, it has become reckless without precedent. And this could be the first day of a serious setback to this. And I think what we can see out there is the public's common sense has been overwhelmed by experts in government, experts in many government agencies, and in England and elsewhere, the United States now, there is a popular uprising against the experts in government. Well, I think you can extend that to monetary conditions, whereby the experts have been managing interest rates and foreign exchange values and all that, and the public has just gone along on it because, hey, these are the experts. These guys know. So then the next contraction, which may be starting, the folks are going to get their common sense and say, look you took all of our tax money. You did all of this stimulation, called it quantitative easing, bazooka money, or even helicopter money, and it didn't work. So the public can be very critical, and as Victor Hugo wrote, there's nothing more powerful than an idea whose time has come. So as part of the changing politics here, it's going to include a severe criticism of reckless central banking, and I welcome it. We're going to live in, as the Chinese say, Jim, in interesting times.
Bob, thank you so much for chatting with us.
Jim, it is always good to be with you, and we look forward to next week.
My guest has been Bob Hoye. He's a market historian and chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. On YouTube, we're Talk Digital Network. You can forward questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.